Credit scores are a crucial factor in the world of borrowing and lending. They are used by lenders to assess the creditworthiness of borrowers, and by borrowers to negotiate favorable terms on loans and other financial products. In this video, we will explore the role of credit scores in borrowing and lending, and the impact they have on individuals and businesses. What is a credit score? It is a measure of the likelihood that a borrower will repay their debts on time, based on their past credit history. Credit scores range from 300 to 850, with higher scores indicating lower credit risk. There are three main credit bureaus in the United States: Equifax, Experian, and TransUnion, that collect information about individuals' credit histories and use that data to calculate credit scores. The factors that are taken into account when calculating a credit score include payment history, credit utilization, length of credit history, types of credit, and new credit applications. The role of credit scores in borrowing. Credit scores play a significant role in the borrowing process. When applying for a loan or credit card, lenders use credit scores to determine whether or not to approve the application and at what interest rate. Borrowers with high credit scores are seen as less risky, and therefore are more likely to be approved for loans at lower interest rates. Conversely, borrowers with low credit scores are seen as more risky, and may be either denied credit or charged higher interest rates to compensate for the increased risk. In addition to determining whether or not a borrower will be approved for a loan, credit scores can also impact the amount that a borrower is able to borrow. Borrowers with higher credit scores may be able to qualify for larger loans, while those with lower scores may be limited to smaller loan amounts. The role of credit scores in lending. While credit scores are important for borrowers, they are equally important for lenders. Lenders use credit scores to evaluate the risk associated with lending money to a particular borrower. A borrower with a high credit score is seen as less risky, and therefore is more likely to be approved for a loan. Conversely, a borrower with a low credit score is seen as more risky, and may be either denied credit or charged higher interest rates to compensate for the increased risk. In addition to evaluating the risk associated with lending money to a particular borrower, credit scores can also impact the terms of a loan. Borrowers with higher credit scores may be able to negotiate lower interest rates, longer repayment periods, and more favorable loan terms in general. Conversely, borrowers with lower credit scores may have less bargaining power, and may be forced to accept less favorable loan terms. Impact of credit scores on individuals and businesses. Credit scores can have a significant impact on both individuals and businesses. For individuals, a low credit score can make it difficult to obtain loans, credit cards, and other financial products. This can make it harder to achieve financial goals such as buying a home, starting a business, or saving for retirement. In addition to limiting access to credit, low credit scores can also result in higher interest rates, which can increase the cost of borrowing and make it even more difficult to pay off debts. Over time, this can lead to a cycle of debt that can be difficult to break. For businesses, credit scores are also important. A low credit score can make it difficult to obtain financing for operations and expansion, and can also impact the ability to attract investors or partners. This can limit the growth potential of the business and make it harder to compete in the marketplace. Credit scores play a crucial role in the borrowing and lending process. They are used by lenders to assess the creditworthiness of borrowers, and by borrowers to negotiate favorable terms on loans and other financial products. Credit scores are based on an individual's credit history, and take into account factors such as payment history, credit utilization, length of credit history, types of credit, and new credit applications. For borrowers, credit scores can impact whether or not they are approved for loans and other financial products, as well as the interest rates and loan terms they are offered. For lenders, credit scores are used to evaluate the risk associated with lending money to a particular borrower, and can impact the terms of the loan. Low credit scores can have a significant impact on both individuals and businesses, limiting access to credit and making it more difficult to achieve financial goals. It is important for individuals and businesses to monitor their credit scores regularly, and take steps to improve them if necessary, such as paying bills on time, reducing debt, and disputing errors on credit reports. In conclusion, credit scores play a vital role in the borrowing and lending process, and can have a significant impact on the financial well-being of individuals and businesses. Understanding the factors that impact credit scores and taking steps to improve them can help borrowers achieve their financial goals and lenders manage risk effectively.